Hi, this is Charlie coming at you from yourannuitymaster.com, and welcome to today's webinar. Today we're going to discuss the difference or differences between variable annuities and fixed index annuities. And though there are similarities because they are both annuities, there are probably more differences. So we're going to jump into really what those differences are. That's probably one of the biggest questions that we get here among our staff is people will call us or we will talk to some of our prospects at times, our clients, and they'll say, you know what, I already have an annuity, and but I just don't understand what's going on with it. Oftentimes we'll sit down and start looking at the paperwork, the contract language, and we'll discover that they have a variable annuity. And there are some big differences between a variable annuity and a fixed index annuity. But for the time being, let's just start off with the basics at this point as to what an annuity is, okay? Simply, it's a fixed sum of money paid to someone annually for the rest of their life. And the word annuity comes from the word annual. Okay, quite simply, it's a contract with an insurance company where an investment, a sum of money is given to the insurance company in exchange for a guaranteed return rate and a guaranteed source of income for life. Okay, it is considered to be extremely secure. And it produces tax-deferred retirement income. It is safe, low risk, and the principal is guaranteed. Okay, there are also a lot of additional benefits to annuities. Aside from the guaranteed lifetime income, they can also provide long-term care benefits and death benefits as well. So an annuity can really solve several issues or challenges or shortfalls in someone's retirement planning. Okay, now let's take a look real quick at where annuities reside on the investment scale, and we'll point out where the variable annuity is and where the fixed index annuity is, and then we'll start jumping into the differences. Okay, so on the investment scale, you've got a red dotted line that just went across your screen. Everything below the red dotted line shows us an investment where the principal is not at risk, meaning the money you put in is guaranteed to never reduce. Okay. Now, anything above the red dotted line is an investment where your principal is at risk for loss. So the money you put in could go to zero. If you put 100,000 in, your 100,000 could eventually turn into zero if things absolutely do not work out correctly. Okay. Now, let's start at the bottom and look at the first thing down here. The first thing is going to be cash. Okay, cash, put the money in a shoebox, slide it under your bed. That's really what we're talking about. My grandparents were in the Depression era. My parents were born in the Depression era. And they had a different view of finances than you and I do today. They didn't really trust financial institutions. So they kept a lot of cash. There was a lot of, I remember my grandfather could pull out just a roll of $100 bills, and that's what he carried around with him. My father-in-law did the same thing. So they just came from a different generation than us. But that's really basically what cash is, okay? The next thing is a money market account. This is nothing more than a fancy savings account at a bank, okay? When I was 12 years old and had a paper route, I had a savings account that my money went into. It probably paid me 3 to 3.5% at that age. But today you can barely get 0.5% on a money market or a savings account with a bank just because interest rates are so incredibly low. The next thing is you have a CD, certificate of deposit. Put X amount of money in today, put $25 in today, and in 30 years it'll be $28. Okay, I'm being a little facetious with that comment, but you kind of know what I mean, okay? The next level that we move into are what we call fixed annuities, okay? Fixed annuities are quite simply exactly what I mentioned on the previous slide. You come to the insurance company, or you can come to the agent really, and you say, you know what, I've got $400,000 and I want to secure this money and I want it to pay an annual income to me for the rest of my life. That's what a fixed annuity is. The insurance company gives you a fixed guaranteed rate of return on that. They guarantee the principal, and you begin to receive monthly, quarterly, semi-annual, or annual payments on that for the rest of your life. These can be stretched out for just payments to you. They can be joint spouse related. There's a lot of options for how the income on a fixed annuity is paid out. Okay, now we're going to jump up to things that are above the red line. Okay, the first thing you have above the red line are bonds. Okay, a lot of bonds revolve around government. Okay, the next thing you have is you have mutual funds, and then you have stocks. If you're participating in a 401k plan, if you have an IRA that you own personally, if you have a Roth IRA, anything like that, typically those kind of funds are oftentimes going to be tied up in mutual funds. If you are really, really aggressive, then your plan administrator will, open up some doors for you to invest directly in stocks. But most people, tend to go the mutual fund route. Okay. Now, you see a couple of empty spaces here, and what these two empty spaces are is where a fixed index annuity would fall and where a variable annuity would fall. Okay. Now, what we're going to take a look at is really what's the difference. Okay. What's the difference in these? Okay. But before we jump, because what you see here is that one of them is on the lower scale where the principal is not at risk. That's the fixed index annuity, but the variable annuity is above the line in the category where your principal is at risk for loss. Okay, so there are a lot of differences between the two products. Before we get into the differences, though, let's take a look at the similarities between the two. Okay, between a fixed index annuity and a variable annuity, first of all, they're both investments that accumulate interest. Okay. The second similarity, is they both have the opportunity for lifetime income payout. Okay. The lifetime income payout, that's when you officially do what they call annuitize it, which means you are activating it for payouts. Okay. So both products provide options for lifetime guaranteed income payout. Both products have options for long-term care and terminal illness options. Okay, a lot of people don't realize that, but annuities are incredibly versatile products that can be used for a whole host of reasons. Okay, there's a lot of myths that float around about annuities. That your money's locked up, you can never touch it. That when you die, the insurance company gets to keep it all. These are all myths. Okay. And there's another webinar on here about annuity myths being debunked. So I urge you to, take some time and review that one as well. The next similarity is death benefit paid to heirs. So when you pass away, if there's still an account value, that account value is not kept by the insurance company. That account value, remaining account value, is paid out to the heirs of the annuitant. Okay. Now, let's jump over and take a look at the differences, because you will find that the differences are much bigger than the similarities. Okay, the first thing we're going to take a look at between the two is with a fixed index annuity. As you remember on the chart, it falls below the red dotted line. So in a fixed index annuity, your $100,000, let's say that's how much money you're putting in. The $100,000 you put in, or however much that money is, that principal is guaranteed. So that $100,000 will never be less than $100,000. Okay. With a variable annuity, your principal is not guaranteed. Okay. It is not guaranteed. If you put that same $100,000 into a variable annuity and that annuity is poorly managed, you could lose everything. Okay. Second difference between the two of them. The upside market growth in a fixed index annuity tends to be more conservative. Okay, but you're exchanging the safety and the guarantee of the principal for a more conservative growth. Okay, with a variable annuity, typically the upside market growth is going to be more aggressive, but to get that upside market growth, your principal is not going to be guaranteed. Okay, so there's always a give and a take. If you want security, then you're going to, if you prefer the security over the risk of the growth, then you need to be in a fixed index annuity. If you are still a bit of a gunslinger and you still really want to pump some money to try to earn some interest, then variable annuity is probably a better product, okay? The next difference, with the fixed index annuity, you do have upside market growth potential, okay? And the funds are linked to a market index. They're not linked to the market itself. They're only linked to an index of some type to the S&P 500. There's a lot of variations for how these indexes are measured and how these indexes are calculated. Some are point to point, some of them have a cap, some of them have a spread. So when you get into working with your annuity master agent, they'll be able to go over the specifics of these kind of strategies, okay? With a variable annuity, your funds are invested directly into the market, okay? So you can choose where you want those funds in and how aggressive you want those investments to be. With a fixed index annuity, you can also choose where you want that index to be tied to. So there are choices on both, but the fixed index annuity is going to be more conservative because it's connected to an index, whereas the variable annuity is more aggressive because the funds are actually invested into the market. Now, the next difference that we see is that with the fixed index annuity, since your principal is guaranteed, your return is never less than zero. So with fixed index annuities, you will often hear zero is your hero, meaning that when the market tanks and the market drops, 20% or 30%, your value of your fixed index annuity is not going to do the same. It's going to stay, it's going to lock in at the level where it is when the market dropped. And it will never, now your return could end up being 0% for a year, but it can never be less than zero, okay? However, with a variable annuity, your return can be negative. Your principal is not guaranteed. You're exchanging the guarantee on the principal for a bigger opportunity for higher returns, okay? So your return, though, can be negative, okay? Now, annual reset locks in value. So if your fixed index annuity grows by 7% and you have a $100,000 annuity, and the first year that growth of 7% takes it to $107,000, what happens that year is that it resets. Okay, it resets and it locks that new level of 107,000 in. So that is now considered your principal. And if the market declines significantly in that second year, then your fixed index annuity remains at the value of $107,000. So it's got an annual reset based on the growth. Okay, a variable annuity, your returns can be much more volatile. Okay, but your ability to control that volatility is really based on how you work with your broker, your agent, and structuring that. Okay. The last thing that we'll talk about, the differences here, is with a fixed index annuity, the commission, there is a one-time commission paid by the insurer, okay? The commission paid to the agent for the sale of a fixed index annuity does not come out of your principal. So if you invest $100,000, it doesn't get reduced to $98,000 because a $2,000 commission got paid to the agent. That's not how it works. When you put $100,000 into a fixed index annuity, your principal begins at $100,000 and has nowhere to go but up from there. Okay, with a variable annuity, you're paying annual service fees, which are taken from the account. Okay, this is considered managed money, and in the managed money world, there are annual servicing fees. Now, one of the problems that can happen with a variable annuity is that sometimes those annual servicing fees can be so high that they end up offsetting or greatly reducing the interest return for that year. I mean, you could end up with 3% annually of management fees, and the return on your variable annuity is 6%, meaning at that point you're only netting a return of about 3%. So that is something that I've had a lot of people come to me about and be very frustrated with. Always be well aware of whether or not you have a variable annuity or more of a fixed annuity. Okay, now let's move on to our next slide. I am not a huge fan of variable annuities, and this is the reason why. I feel like an annuity, as I explained a little while ago, An annuity is there for safety and security, and it's a product that's targeted for senior citizens. It's targeted for people who are over the age of 50. Okay, and I feel that with a product that's geared and targeted to the senior market, and it's promoted as being safe and protecting principal, that a variable annuity kind of defeats the purpose of that, because with that variable annuity, you have the potential to lose all your money, and I think that is opposite of really what an annuity is supposed to do for someone. Okay. However, your fixed index annuity, I'm a big fan of that because I feel like it has the best of both worlds. Okay. It has a guaranteed minimum return to protect your principal. Okay. And it also is tied to the S&P 500, and it can generate pretty solid returns for people. I have clients who are utilizing fixed index annuities for wealth accumulation. They had a pot of money, and in some type of a company-sponsored plan. They retired. They wanted to move that money over into something more secure and take it out of the mutual fund market. However, they did not need the income yet. So we took that money, we dropped it into a fixed index annuity that was really targeted towards wealth accumulation. So for the next 10 or so years, that fixed index annuity is just going to sit there and cook, and it's just going to keep earning returns. And the client has absolutely nothing to worry about, knowing that the principal is guaranteed, that there's an annual reset on the value, and that the returns can never be less than zero. So they are happy about that. Okay. So really the power of the fixed index annuity, I think, overpowers the opportunity with a variable annuity. Okay. Also, what we can look at is really kind of a third-party source here, but Forbes magazine this year in 2020 stated that fixed index annuities are the Swiss Army knife of retirement planning, and they are absolutely true. The fixed index annuity is like a Swiss Army knife. There's a lot of abilities that it has. It can be tailored for a lot of things. It can be utilized for various types of strategies. Some people, the example I just gave you, some people want to use it for wealth accumulation. Others want to use it for legacy preparation. They will attach riders to it for long-term care options or terminal illness options. So if they become sick or decrepit or need some type of medical care throughout their senior years of life, that the annuity money can be accessed to help cover those costs instead of having to give up other assets within their life, such as having to sell a house to pay for medical care or something along that line. So there are a lot of tools and options that fixed index annuities can provide that other investment vehicles absolutely cannot touch. So what we do is we urge you to reach out to us. Let's start a conversation about this, and let's take a look at the various strategies that we can help you implement to make a fixed index annuity a critical part of your retirement plan. So that's it for this webinar. And if you have questions, hit the contact button or hit the chat box, and we are happy to get those answered for you. Thanks a lot.